We are told here, December 2023, question number 2B, 𝗕𝗏𝗙𝗚𝗃𝗚, an investment specialist, has been entrusted with 5 million by an investment club and instructed to invest the money optimally over a 1 year period. So we are told here, part of the instructions are as follows: the funds be invested in one or more of the 3 specified projects and in the money market. So we have 3 projects, and then they're also told here to invest in the money market. The 3 projects are not divisible and they cannot be postponed. The investment club requires a return of 14% per annum. The following details relates to the projects and the money market here. So we have project 1, initial cash outlay, forecasted rate of return, percentage, good thing for us. Expected standard deviation of return, percentage. Number 5, the correlation coefficients of returns of the above combination of projects are given there. They've given us something nice there. Additional information, the risk-free rate of return is 12%. Number 2, expected return of the market portfolio is a weighted average return. Given below are forecasted rates of return from a market portfolio and their probability of occurrence in different states of nature. So we have states of nature there. We have probability, forecasted rate of return. Evaluate how 𝗕𝗏𝗚𝗃𝗚 should invest the 5 million using the capital line market. And then number 2, using CAPM, capital assets pricing model. Now, this was a very interesting question, to be very honest. I was involved in setting this kind of a question, not last semester, but for CIFA. This was a CIFA question sometime back when I was young, when I was still setting this. So they stole this question from CIFA and I did bring it to the CPA. So my thinking here, which of course was able to get most of the students off the radar, not many would interpret this question. You see, ladies and gentlemen, how much do we have in total to invest? How much do we have in total to invest? We have 5 million in total to invest. All right, let me read this question again. We are told 𝗕𝗏𝗚𝗃𝗚, an investment specialist, has been entrusted with 5 million by an investment club and instructed to invest the money optimally over a 1 year period. The instructions: the funds be invested in one or more of the 3 specified projects and in the money markets. So he's been told to invest the entire 5 million in one or more of those projects where money market is also a project. We are told the 3 projects are not divisible and they cannot be postponed. The investment club requires a return of 14% per annum. The following details relate to the projects and the money market. So please listen, note number 2, the 3 projects are not divisible and they cannot be done what year? Cannot be postponed. But now, ladies and gentlemen, what does that really mean? What does that really mean? So I would want us straight away to look at the project combinations, because you see 5 million cannot fit in any project there, one project there. You can see we have got P1 all the way to money market, and you can see the initial outlays. Like project 1 is 3 million, which is less. So you don't want, the person who has given us to invest this money for him does not want any refund. He wants you to fit the 5 million into one or more of those projects. Then I expected my good students of CIFA to look at what we call project what year? Project combinations. Let's try combining these projects here. Let's try combining these projects in a way that they will be able to fit 5 million. So we shall combine project 1 and project 2. So we're looking at combinations. So we shall combine project 1 and project 2. You see, project 1 is going to cost 3,000. Project 2 is going to cost how much? 2,000. How much do we have in total to invest? 5 million, isn't it? Let's call it 5,000. Thank you very much. So you see, if we combine P1 and P2, then we shall be able to exhaust the 5,000. Let's combine P1 and P3. P1 and P3 is a possible combination because P1 is 3,000, P3 is 2,000. P3 is 2,000 as well. P3 is 2,000 as well. So 3,000, 2,000, 5,000. Let me ask you great ninjas a question. Do you think we can combine P1 and a money market? Can we combine P1 and the money market investment? Can we combine P1 and the money market investment? Oh, most of the students don't have this question. And I've already laid down the concept. No, because P1 and the money market investment will need a total of 6 million, which we don't have. We'll need a total of 6 million that we don't have. We only have 5 million. So then that is not possible. So then which other combination do you think, ladies and gentlemen, can work? If you are able to follow, which other combination can work? Remember, we have P1, we have P1, P2, P3, we have MM. So you have said P1 with P2. You've said in this case here P1 with P3. That's very good. But P1 with MM, impossible. Because the two will, in this case here, take more than what here? Will take more than 5,000. Which other combination you guys were saying here? P2 with MM. So we have this P2, because you see P2 is 2,000 and MM is 3,000. So that we shall be able to exhaust our 5,000. So we have here P2 and what here? And MM, I'm happy. P2 and MM. P2 and MM, yes. P2 and MM. Any other combination that you think will be able to exhaust 5 million fully? Any other combination that will be able to exhaust the 5 million fully? I can see CPA there. Yes, P3. I mean P3 and MM. Because you see P3 is 2,000 bob. P3 is 2,000 bob. P3 is 2,000 bob. And the moment in this case here that you take P3 and MM, you'll be able to exhaust. So we have this one as the last one. P3 and what here? And MM. So let me do the first screening. What will be the expected returns if we do these combinations? What will be the expected returns if we do these combinations? If we do these combinations, what will be the expected return? 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 Is there somebody who is able to give me this? If we do P1 and P2, for example, P1 and P2. If we do P1 and P2, what will be the expected return in that portfolio? Because now we call it a portfolio. So I want you to create a column here where we capture what we call expected return. What we call expected return. What we call expected return. This friend of ours is giving us 14%, maheni, ni kweli 14%. Uongo, sababu unajua ukiongeza hizi mbili itakuja 5,000. Kumaanisha weight ya project 1 itakuwa ni 3,000 over 5,000, because you see now we need the weights. Kumaanisha weight ya project 1 itakuwa ni 0.6. Alafu weight ya project 2 then itakuwa 0.1 here somebody, because the two must always add up to 1. The two must always add up to 1. Remember, I'm looking at this. P1 is 3,000, P2 is 2,000. So because to get expected return of a portfolio, you shall take weight 1, expected return 1, plus weight 2, expected return 2. So the weights are very, very important. So first of all, are we in agreement as regards these weights? Are we in agreement as regards those weights? I need to pull the board. Oh, they can't see very well. This board, I can't push it very well, but I hope they're able to get them. You see, like project 1, the amount going into it is 3,000 out of the total this guy that has given us, which is 5,000. So then abracadabra. So expected here then, if P1 weight is 0.6, is there somebody who is able to see expected return of 1? Expected return of 1. The forecasted return of 1. I can see somewhere there. Expected return of 1, I can see it is 16 way. But forecasted return. Or forecasted return for P1. Or forecasted, so plus weight 2, which is 0.4, times expected return here, P2. Expected return here, P2 here, which is what here? Expected return here, P2, which is expected return here, P2, which is what here? Expected return here, P2. Pale kwa forecasted return. Forecasted return. Pale kwa forecasted return. Are you able to see the one of P2? Yes, 15. Yes, 15. So then can you kindly give me this figure? Can somebody in this case here give me this figure? If we combine P1 and P2, how much do we expect to get? If we combine P1 and P2, how much do we expect to get? If we combine P1 and P2, we expect to get 15 point what here? We expect to get 15.6, yes. We expect to get 15.6, yes. So then do you think this particular combination will be accepted by the investor? Then the investor gave you a condition that ensure your investment, how you are investing these portfolios, whatever portfolio return you will give me must be at least 14%. There is a rule which they gave us there. They told us there, look at note 3. The investment club requires a return of 14% per annum. So then this is more than 14%. This is more than 14%, and therefore this is acceptable. It is acceptable. You write like that. It is acceptable. It is acceptable. So then, ladies and gentlemen, can you kindly go ahead and give me, the second return, P1 and P3. Now we are combining P1 with P3. P1 with P3. Abracadabra. Abracadabra. P1 with P3. Let me put my book down. P1 with P3. Let me put my book down. I would want to see reasoning from my students here. I would want to see how my students are reasoning today. According to 𝗕𝗚𝗙𝗪, and 𝗕𝗚𝗙, I've not also seen your work, 𝗕𝗚𝗙, nowadays, 𝗕𝗚𝗙. What happened? What happened? It used to be very good. Or you're still nice, but you don't have time. You must create time. You must create time. So according to 𝗕𝗚𝗙, Juliana C2, they're getting 18.4. They're getting 18.4. 18.4. 18.4. They're getting 18.4, and they're telling me that this is acceptable. Is there any ninja who has not gotten this 18.4? Then I show them. Is there any ninja who has not gotten this 18.4? I get to show them. Is there any ninja who has not gotten that 18.4? I get to show them how they. Yes, okay, no problem. Paul has not gotten. So you see, P1 is still 3,000. P3 is 2,000. So then that means that the weights are still the same, because the weight 1 will be 3,000 over 5,000. The weights are still the same. Weights are the same like the weights we got up here. So then abracadabra, I will come and take, in this case here, the first weight times expected return of P1. Expected return of P1 is still 16. Plus the second weight, which is 0.4, times expected return of P3. Are you able to see expected return of P3? Buana Paul, it is given there under forecasted returns. It's given there under forecasted returns. 22. Paul is saying 22. Thank you so much. 22. So that is what they did to get that 18.4, meaning that this is again acceptable because it's beyond our hurdle rate. It's beyond our hurdle rate. Then we go to P2 and the money market. Let's go to P2 and the money market. Is there somebody who is able to give me the expected return of P2 and the money market? Remember P2, this time around P2 is 2,000. 2,000. Money market, you're 3,000. So the weights are going to change slightly. The weights are going to kind of reverse. The weights are going to kind of reverse. So according to Matayo Ambani, 13.2. This great man from Luyaland. I remember the Ambani brothers. I don't know whether you know them. They used to play football a long time. 13.2. Nancy is getting, Will is getting 13.2. Matayo, you're getting 13.8 instead of 13.2, Matayo. Matayo, check again. It's supposed to be 13.2. Check again. Check your weights. Because you see, if it is 2,000 and 3,000, then weight 2 here. Weight 2 will be 2,000 over 5,000. Weight 2 will be 2,000 over 5,000. So weight 2 is going to be 0.what here? 0.4. And then we have weight of money market. Weight of money market, it will be 3,000 over 5,000, which will give me 0.what here? Which will give me 0.6 like that. I need to increase the size of my camera. All right. But I hope somehow you guys are able to follow somehow. I hope somehow you guys are able to follow. So, ladies and gentlemen, we have the weights already. So I'll take 0.4 as the weight of product 2 times its expected return. Expected return of P2. You guys are giving me expected return of P2 as 15. As 15. Plus 0.6 times expected return of money market. Expected return of money market ni ngapi? 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 expected return of our forecasted return, 12. So if you do it that way, then you'll be able to get 13 points. Do you think the investor will allow this kind of investment to go on? Do you think the investor will allow this? So this cannot be accepted. So we shall simply write in brackets, rejected. We shall simply write in brackets here, rejected. Rejected like that, rejected. Rejected. We shall simply write in brackets, rejected. 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 Let's be my friend. Ningejua nikikupatia siri, Ningejua nikikupatia siri. Rejected. Rejected. But up to here, ladies and gentlemen, are we together? Are we together up to here? Are we together up to here? All right. So please go ahead and give me P2 and MM. And this one I will not do it. Give me P2 and MM. What is the expected return of P2 and MM? P2 and MM, 16%. P2 and MM, 16%. So accept because it's more than 14%. How about P3 and MM? How about P3 and MM? P3 and MM. P3 and MM. P3 and MM. 16, P3 and MM, again, they are telling me that this 16 is common to both. 16 seems it's common to both. P3 and MM is 16. P3 and MM is 16. So accept. A good student is asking, why are we not taking some combination? There is a student who is asking, why are we not taking this combination of what and what? Why are we not taking, I like students who ask questions like that. Why are we not taking combination P2 and P3? You mean you don't have P2 and P3? It's because P2 and P3, where is P2 and P3? So we have P1, P3. How about P2 and P3? How about P2 and P3? Has 𝗲𝗏 left it out? Has 𝗲𝗏 left out P2 and P3? They are saying that P2 and P3 is compatible. Let's see. Let's work out this thing very well. So we have here P1. Let's not leave any compatible pairs here. Then we have money markets here. So P2, this P1 is 3,000. This is 2,000. This is 2,000. This is 3,000. So then our combinations, we have P1, P2. Correct. We have P1, P3 because they will add to 5,000. Correct. P1, P3. And then we have P2, P3 is compatible. P2, P3 is compatible. But what will this really mean to us? It means that we refund the client 1,000. We refund the client 1,000. Do you think this client will be able to give you any money? Do you want the client in this case here to have, in this case here, like excess? Because the client has given you 5 million, you must get away of utilizing it fully. You must get away of utilizing it fully. Are we together now? Are we together now? We won't exhaust the 5 million. Are we together now? Thanks for asking that question. Thanks for making that contribution. Are we together, or do you want me to explain further? That if you combine P2 and P3, you shall end up spending 4,000, and the investor wanted you to invest 5,000 or 5 million. Are we together now? Are we together now? I'm alone. I'm alone. Purity, I have 4 combinations. Do we have 4 combinations? 1, 2, 3, 4. Yes, there are 4. There are 4, but one has failed the test. One has failed the test. Any student who failed this combinations test got a 0 in the entire question. It was these combinations that really mattered in this question a lot. And I'm happy to see that you guys would have been able to combine those securities very nicely. I'm happy to see that you guys would have combined those securities very nicely. All right, now we can now go and address the questions there. So let's read the question now. Evaluate how Daniel Wekesa would invest the 5 million using CML and the CAPM. Ladies and gentlemen, remember we have what we call CAPM returns. Whenever we talk of CAPM returns, always we must start with risk-free. So risk-free plus who? Risk-free plus who? Expected returns of the market minus risk-free multiplied by beta of the security. This is very important. 𝗕 beta. But how about the portfolio equation? How about the portfolio equation, also called the capital market line? Capital market line. So for capital market line, CML, the one asking number one, the portfolio, we don't in this case here use just, this one here we're using systematic risk alone. 𝗕 is systematic risk alone. CML makes use of what we call total risk. CML makes use of what we call total risk. So in this case here, we have CML RS. So it will be RF plus ERM minus RF. But now we're using total risk, which is measured using what here the standard deviations, which is measured using the standard deviations like that. So everything is similar. And by the way, even this one, it has a BM somewhere. Even this one of 𝗕 has a BM somewhere. Only that we know the value of BM. Is there somebody who knows the value of BM? Is there somebody who knows the value of BM? It's an obvious thing. It's an obvious thing. BM is always 1. BM is always 1, and that is why we do what here? We omit it from there. BM is always 1, and that is why we omit it from there. Otherwise, it's supposed to be here. Now, ladies and gentlemen, please listen. Please listen. You see, they want us to evaluate portfolios. They want us to evaluate portfolios using this CML. So then this one here will be CML returns of a portfolio will be equal to RF into ERM minus RF into standard deviation of what here? Standard deviation of a portfolio. And we have 4 portfolios to evaluate. We have 4 portfolios to evaluate. So each of these portfolios, I would need, in this case here, you guys to give me standard deviation over each of the portfolios. The first portfolio that I have is portfolio P1 and P2. P1 and P2, this one. You can write it like that. Fortunately, we have weight 1, we have weight 2. We have weight 1, weight 2. So for P1, what was weight 1? P1 and P2, when we are combining P1 and P2 up there. Is there somebody who is able to give me weight 1? Weight 1 equals what? Weight 1 equals what? The board has a problem. Oh, sorry. Are they able to see it somehow? Are they able to see the formula somehow? Because we have the CML returns of the portfolio. All right, thank you very much. So in this case here, weight 1 is 0.6, and then weight 2 is 0.4, like that. Now, ladies and gentlemen, do we have the standard deviations? Is there somebody who can read for me the standard deviations of 1 and 2? Is there somebody who can read for me the standard deviations of 1 and 2? Standard deviation, please go to that first column. The first table, you'll be able to see the last column. We have standard deviation of 1 is 8. And then standard deviation of 2, in this case here, is what here? Standard deviation of 1, project 1 is 8. And then standard deviation of 2 is what here? Is 6. Now, let me ask you the last question. This examiner gave us correlation between 1 and 2. Are you able to see the correlation between 1 and 2? Are you able to see the correlation between 1 and 2? The examiner has given a second table there where he has captured correlations. Where he has captured correlations, somebody? Where he has captured correlations? Where he has captured correlation? The examiner has given us a place there where he has captured correlation. You can see correlation note number 5. Correlation coefficients between P1 and P2, 0.9. Thank you so much. Thank you so much. 0.9. Now, in our yesterday's class, actually, Juicy, I taught you guys how to get standard deviation of a portfolio of this nature. I would want to give you 1 minute to see whether there is anybody who will be able to give us this standard deviation of the portfolio between projects 1 and 2. I'm giving you 1 minute as I adjust my camera because I need a bigger board. All right. So we are evaluating the first portfolio. We are evaluating the first portfolio. I can see Madam winning here, giving me 7.2%. Please don't be writing the percentages. Don't be writing the percentages to avoid confusion. We shall not be writing the percentages. We shall not be writing the percentages. P1 and P2. P1 and P2, standard deviation of the portfolio. Hilda, 0.9. I think you are answering the question regarding correlation, which you had given me an answer earlier on. So I simply want you to now give me the standard deviation of the combined portfolio, which has got projects 1 and projects 2, which has got projects 1 and project 2. Which has got projects 1 and project 2, project 1 and project 2. So according to Doris George, she has 7.04. 7.04. There is somebody who has a 7.8. I like whenever I see a democracy, students giving me different answers, the better for me. The better for me. Now, my good students, imagine this is not a hard thing. Imagine this is not a hard thing at all. Not a hard thing at all. Because what I'm required to come and do is to come and remember that formula. Standard deviation of a portfolio. It's a big square root. Then we have, in this case, the weighted the standard deviations, weight 1, standard deviation 1, plus weight 2, standard deviation 2. So we come and square, plus twice. We normally use the covariance approach or the correlation approach. So here the examiner has given me the correlation. I will not cry. I know the concept. When the examiner gives me the correlation, so I'll come and say correlation like that. Then when the examiner gives me correlation, I must always attach the standard weighted deviation. I must always attach the standard deviations. And then I'll end it up by putting the weights. Weight 1, weight 2. Is there somebody who was able to remember this? Is there somebody who was able to remember this concept? Is there somebody who was able to remember this concept? All right, great. Let's see here. So we have our weights. Weight 1 here is 0.6 squared. Standard deviation 1 is 8 squared. Plus weight 2. Weight 2 is 0.4. Times standard deviation 2, which is 6 squared. Plus twice R between 1 and 2. R1, 2 is 0.9. Times the standard deviation 1, which is 8. Standard deviation 2, which is 6. Times the weights, both weights, 0.6 times 0.4. Quite complicated, but you can't avoid this thing in your exam. We must understand this. Leslie, I'm not saying you giving me answers at all. Leslie, this lady with a very hard, her second name is very hard. Nobody can pronounce her second name. Nobody can pronounce her second, even myself, she has told me twice, but I can't pronounce it very well. Paul, they're giving me 7.04, 7.04, 7.04, 7.04, 7.04. Is that okay? 7.04, 7.04. Thank you so much. Thank you so much, Naomi. Great. Alango today, Wonge. Yes, you can substitute, yes. Black Ninja. Great Ninja. Alango Leo, okay? Alango Leo is seeing what we call 𝗕𝗔𝗠𝗪, the one with what here? Spectacles. The one with spectacles. 𝗕𝗔𝗠𝗪. Very bad type of a bad. All right. So then this is the first P1 and P2 we have evaluated. So I would want you to go ahead and evaluate the standard deviation of portfolios 1 and 3, the one that we were able to recommend. Standard deviation of portfolios 1 and 3. Standard deviation of portfolios 1 and 3, abracadabra. Standard deviation, error. We shall overcome. Why should we get Vero and error? Vero, we shall overcome. Alango, today wasn't your day, but we shall overcome. But Alango, are you able to follow? I mean, you know, it doesn't have to be like 100%, but somehow, are you able to follow really? Somehow. Because you're getting the standard deviation of our portfolios. Given what we had recommended up there from our combinations, the ones that passed our hurdle rate, So now we are doing standard deviation of portfolios 1 and 3. Yeah, asante, at least you're following. At least you're following. What is idea vero ya kwanza vero napata error. Young man, give me that calculator. Don't remove, just bring just I'll be able to meet him along the way. All right, so vero so that vero hizi kapata error. Usianza na square root vero wewe. Sema 0.6 squared. Sema times 8 squared plus 0.4 squared times 6 squared plus 2 times 0.9 times 8 times 6 times 0.6 times 0.4. And then the worst mistake you can ever do is to fear that you're going to get it wrong. Never fear. In life, you should never fear nothing. 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 You go ahead and say equals, and then says, we want square root of this, square root of this, square root of this calculator of mine. It's very good, but I can't see the square root. Why am I not able to see the square root really here? Why am I not able to see the square root here? It's because of these bright lights of the studio, but now I've seen it. So square root, answer like that. I'm getting a big thing, so change these two. So it is coming to 7.038. 7.038 is 7.04. So Vero, have you been able to get 7.04? Why not substitute CC? CC stands for what now, Maggie? Mwalimu, I'm getting a different answer substituting. Please try one portfolio. We try one portfolio. We can't get a different answer, imagine. Thank you for raising that. Let's try one portfolio. Let's try one portfolio. Do you want, let me try with the first one. Let me try with the first one. Thank you for bringing that up. All right. So ladies and gentlemen, we know that to get R between 1 and 2, let me use the 1 and 2. To get R between 1 and 2, I will take the covariance between 1 and 2 divided by their respective standard deviations. So they have given me this R between 1 and 2. What is this value? They have given me R between 1, which is 0.9, if I remember very well. So what I would need is to get covariance between 1 and 2. Do we have the respective standard deviations? Yes, we do. There are 8 and what here? 8 and 6. 8 and 6. So then please make covariance 1 and 2 the subject of the formula. It will give us the same. Make covariance 1, 2 the subject of the formula. So if I make covariance 1, 2 the subject of the formula, I will cross multiply. It will be 0.9 times 8 times 6. Is there somebody who is able to give me this answer? Is there somebody who is able to give me this answer? Let's get confirmed without a calculator. 43.2. Maybe she's using her phone. 43.2 like that. Yeah. Now, once I get this, then I'll be able to remember the formula of standard deviation of the portfolio. 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 Standard deviation of the portfolio between 1 and 2 will be weight 1, standard deviation 1, plus weight 2, standard deviation 2, plus twice. Now we're using covariance 1, 2. So now we cannot bring standard deviations here because we multiplied them already. We can't bring standard deviations here. So twice covariance 1, 2. We have in this case here weight 1, weight 2, and then at the end of the day, we shall be able to put a big square root. Here we must square these ones always. So weight 1 is 0.6 times 8 plus 0.4 times 6. These ones here have to be squared like that, plus twice the covariance, which is 3.2 times 0.6 times 0.4, which will end up giving me what figure after taking. It has to be exactly the same, like the one that we got. It must be exact. It must be exact. It must be exact. So please confirm. The students who are telling me when we are getting different answers, please confirm, please confirm. And if you don't mind, let me know where you guys are getting wrong. Let me know where you guys are getting wrong. Let me know where you guys are getting it wrong. Same answer, right? At least this lady has been able to tell me. I looked for square root and I called it standard. I detect the error. We shall overcome. Now, ladies and gentlemen, we are getting now standard deviation between 1 and 3. Oh, yeah. Is there anybody who could be having that figure? This has to be done by all of us really, 1 and 3. So if I write down the formula, standard deviation of portfolios 1 and 3, it will be equal to weight 1, standard deviation 1, plus weight 3, standard deviation 3, plus in this case here twice. If I have the correlation coefficient, I would rather use it the way it is, not unless it's a 3. If it's a 3 security, then that one will give you problems. But I don't like converting. Just do it like this: R1, 3. Correlation is a natural pattern of standard, so I have to bring the standard deviation like that, and then the weights, weight 1, weight 3, like that. And then, of course, we shall be able to put a big square root. So are you able to give me the weights? Weight 1, are you able to give me the weights? Are you able to give me the weights very fast? Just I'll do one more, and then I'll be done. So Nancy has given me this is 0.6 times 8. Plus, of course, there is a square. Plus, what is weight 3? Of course, this will be 0.4 times what is standard deviation 3? Is there somebody who knows what standard deviation 3 is? Standard deviation 3. According to Madam Esther, big name in the Bible, standard deviation 3 is 4. So this has to be squared. Plus twice, what is the correlation between 1 and 3? The correlation between 1 and 3, is there somebody who is able to see the correlation? Oh, Sherry says 10. 1 and 3. Please check for 1 and 3. Check for 1 and 3. The correlation between 1 and 3. They're saying, others are saying 10. Where are they getting 10 from? I don't know. Is there somebody who could be knowing where they're getting 10 from? Oh, they're talking about standard deviation. They're talking about standard deviation of project 3. It's 10. They're talking about standard deviation of project 3. It's 10. You're right. It is 10. It is 10. Plus twice times correlation between 1 and 3. 1 and 3 correlation is 0.5. 0.5 times 8 times 10 times 0.6 times 0.4. Whatever I will get there, I should be able to get a square root. What are we getting there as our standard deviation? What are we getting there as our standard deviation? Abracadabra. The final answer, everybody, they should be able to give me an answer. People, 7.63, like that. 7.63. Is there somebody who is able to remind us what is the other pair that we took? We took some other pair. It was between which project and which project? We are left with the two. We took other pairs. Project 3 and MM. So we took it. So in this case here, come and give me the standard deviation of project 3 and MM. Standard deviation of project 3 and MM. Standard deviation of project 3 and MM. Standard deviation. Imagine 𝗖𝗔𝗙𝗻𝗙 stress. 𝗖𝗔𝗙𝗻𝗙 stress. Because what I need to do is to come and talk of weight 3, standard deviation 3. Weight MM, standard deviation of MM. Plus twice R between 3 mm, standard deviation 3, standard deviation mm, weight 3, weight mm like that. And then of course there must be squared here. Squares like that. And so long as you have the weights, then automatically, like Paul has already been able to do this. Paul is a great ninja. Aquila, thank you very much. Aquila, good to see you. And Aquila gave me something very nice, and I finished drinking it. Aquila, can I get another one? Of course, now you have to give me at a price. You gave me very good coffee. You can talk about that after our class. So in this case here, there is somebody called Aquila and Paul here. They're giving me 4.96. 4.96 like that. Thank you so much. Then we had some other combination. We had some other combination. So I suppose everybody has been able to get this, and if that is the case, then I should be able to go to the next combination. The other combination ilikuwa gani? Yeah, P2 and MM now. P2 and MM. Ala, tuliruka. Tuliruka kwa P3 kwanza. No problem. No problem. So P2 and MM. So please, I remember one time somebody was telling me, Mwalimu, I mean, why don't you like get many children? Why I fear getting children. Very many reasons why I cannot get more than 2. Very, very many reasons. One of the reasons, akamtoika kiwa kadogo, hata kanalia, akaweza kuambia kwa mgonjwa wapi. Unaona? Sasa wewe pia usiwe kama mtoto, wewe ni mtu very big kama mimi, or much younger, you could be like 20 years. But at least you should know to say, hey, I haven't gotten that figure. Please, Mwalimu, help me out. Mwalimu, help me out, and I'll be able to help you out right away. I'll be able to help you out right away. P2MM was rejected, eh? Oi, kama ilikuwa rejected, kama ishakuwa rejected, please musitafute tena. Kama imekuwa rejected, was P2 and MM rejected? Was P2 and MM rejected? The ones that are rejected, we are not calculating them anything at all. The pair that was rejected, P2 and MM. P2 and MM we rejected. Don't calculate. Don't calculate. P2 and MM, if it was rejected, don't calculate. Give me only the combinations that we accepted. So have we been able to get the standard deviation of the portfolios of combinations that we accepted? All of them. All of them. All of them. All of them. Oh, you're gonna not rejected. Oh, yeah, not rejected. Alama not rejected. We rejected it. Do you know why? Because if we write here, P1, P2, P3, MM. So P1 was 3,000, isn't it? P2 was 2,000. This was 2,000. It wasn't rejected. It wasn't rejected because you see P2 plus MM ni ngapi? P2 plus MM ni 5,000. P2 plus MM ni 5,000. P2 plus MM ni 5,000 ama? Ngoja kidogo. Ngoja kidogo tuelewane. Ngoja tuelewane. Oh, the return was 13.2 was less. Thank you very much. Because we had another criteria as well. The return was below 14%. Then I accept. So now, Alango, are we together? It was rejected. Alango, are we together? It was rejected. Purity, this was rejected on the basis of expected return being less. Being less. This is my best class. At least you're able to discuss things here. You're able to discuss things here. Now we are together, all of us, including the one who got 7.45. It was rejected. So then can you kindly tell me, is there any other pair that was accepted which you haven't calculated? Is there any other pair that was accepted that you haven't calculated yet? We have calculated all of them, right? Thank you so much. Then now we are okay. Now the only thing that I would want you guys to do for me, remember, when it is CML, returns over my portfolio, I'm getting, in this case here, risk-free. I have the expected returns of the market minus risk-free. We have standard deviation of the portfolio here. And then now down here, we have the standard deviation of the market. Already we have taken care of this. Now, the only thing we need to get here is the standard deviation of the market, where I will come and take returns of the market minus expected returns of the market. In this case here, we square times probability. We must sum, and then at the end of the day, square it. So do we have returns? Is there somebody who is able to see returns of the market? Anybody who is able to see returns of the market? There are actual returns of the market. Actual returns of the market. Actual returns of the market. What do we have? Actual returns of the market in note now. Additional information 2. I can see 10, 15, 12. 10, 15, 12. 10, 15, 12. Minus, minus, minus. Is there somebody who can do ta-ta and give me the expected return? Somebody who can do tata and they give me the expected return. Understand? Look at tata kweli. Tata, tata, tata. Most tribes, mtu akianza kuongea hivi, jina ya kwanza nasemanga ni tata. Most tribes. Unless you're not coming from Bantu. Watu wengi Bantu. Watu wengi Bantu wakianza kuongea wanasemanga tata. So it is 10, 15, 20, not 12. How did I get 12 even myself? It is 20. Nimefunzwa pale na ngua sio tata. Tata dada, okay. So then give me the expected, you guys, man. Come and give me the expected return of the market. Expected return of the market, tata. this will be 10 times the probability. So we have here 10 times 0.3 plus, we have here 15 times 0.4 plus, we have in this case here 20 times 0.3. 20 times 0.3. So is there somebody who is able to give me that Thank you so much. Ati ni 3. Ala, 3 unatoa wapi? Au usifanye hivyo moja moja, unashikanisha yote na calculator wewe CPA. Ala, unafanya mara moja yote unashikanisha 15 hivyo. So ERM inakuwa constant throughout. So inakuwa 15 15 15 constant throughout. Alafu huyo unasema squared times now probability. Probability, what do we have there for probability? I can see them there. 0.3. We have here 0.4. And then we have in this case here 0.3. So is there somebody who is able to give me these answers pretty fast? Anybody who is able to give me these answers pretty fast? Anybody who is able to give me these answers pretty fast? Oh yeah. Oh yeah, the first one. You simply say into brackets here, open brackets 10 minus 15. Square times 0.3. Vero, are we together? Vero, ulipotea kitambo. Vero, are we together? Oh, 7.5. According to Rose M, 7.5. Ya pili mimi najua sana ni 0 ziniambia. Ya pili mimi najua sana ni 0. Ya pili mimi najua sana ni 0. Vero nasema niko 2. Niko lakini mashida mengi, but we shall overcome. Vero, I hope you are able to see it in a way that later on you can practice. Ya mwisho kabisa nakuja ngapi? Somebody Sherry 7.5. Alafu na add. Ukiadd itakuwa 15 because of this summation, itakuwa 15. Kwa hivyo standard deviation of the market itakuja ikue standard deviation of the market itakuja ikue square root of 15, which will end up giving me what figure? Standard deviation of the market 3.87 like that. Haya. Sasa hebu angalieni maajabu ya Musa. Angalieni maajabu ya Musa. Oh yeah, as we finish. Angalieni maajabu ya Musa sasa. Unaandika in capital letters. Hata kama understand chochote unaandika in capital letters, unasema CML returns. Unaandika hivi CML in capital letters. CML returns. So unaanza na portfolio 1 and 2. Unakumbuka formula ya CML returns. This one here will be equal to risk-free rate of return plus expected return of the market minus risk-free. And because it's capital market we take the total risk. Total risk is measured using standard deviation. So I'll come and take the standard deviation of the portfolio over standard deviation of the market. So therefore, the CML returns here will be equal to, is there somebody who is able to see the risk-free rate of return? Is there somebody who is able to see the risk-free rate of return in this question? Sito nasema 12. In note number 1, risk-free is 12. 12 plus, is there somebody who is able to see expected return of the market? Anybody who is able to see expected return of the market? 15. Already we have it. 15 minus 12. How about standard deviation of this portfolio 1 and 2? Portfolio with 2 securities 1 and 2. We have already computed this standard deviation of this portfolio 1, 2. We computed this somewhere. Are you able to see that standard deviation of that portfolio? It is 7.04. So times 7.04, divide this by the standard deviation of the market. You guys gave me a figure of 3.87. I'm not seeing all students in this case here participating, and I would want to really help you guys. You'll be surprised. I would want to help you guys. Please just punch your calculators and give me these answers. I want to help you guys. 17 point what here, somebody? 17.46 like that. Now, you will be able to do all this for the 3 portfolios that we have. And then now you must come and calculate for me the Jensen's alpha values. The Jensen's alpha values. So Jensen's alpha value, we know that alpha over any security should be equal to expected return minus, of course, we use CAPM, but here it was CML. CML returns of that security. So for example, like now here, the Jensen's alpha value for this portfolio 1, 2, In Roman 1, is there somebody, the one that we did, the combinations one, is there somebody who is able to see the expected return of the two securities? Is there somebody who is able to see expected return of the two securities? We did this somewhere there in the combinations, what we were evaluating. We were able to combine and we got expected returns. We got the expected returns. We got the expected returns. Is there somebody who can see that? So we have here 15.6 minus the CML returns. CML returns, in this case here, we have 17.46 like that. CML returns for this portfolio. So I'm able to get a negative thing. I'm able to get a negative thing. Where did you get the 15 of ERM? It's here. ERM, expected return of the market. We are done this 15 ERM. So somebody is telling me it's negative 1.86, negative 1.86, inefficient. Inefficient, like that, negative 1.86, inefficient. And then you should be able to do like for the 3. Look at the question, what the question was asking. What is the question asking? The question wanted us to evaluate how 𝗕𝗿𝗃𝗃𝗃 should invest the 5 million. If it's inefficient, then this we shall discard it. It passed the 14% test, but if it's inefficient, at the end of the day here, then we shall say no to that one. So we need to go and evaluate the other 2 combinations here, and then advise. In CIFA, we had called this question 𝗕𝗿𝗃𝗃. 𝗕𝗿𝗃𝗃. It was a very good question. Very good question, which you should be able to use as a revision for portfolio. I'm so sure the question was a tough one. But have you been able to get some insights? Like if you get a question that is talking about combining 2 things, you will not be able to get like 0. I mean, there's some free marks there, like the one of getting expected return of the market, standard value of the market, that those were quite low hanging, you know, quite low hanging. All right. Otherwise, ladies and gentlemen, I would want us to end the class right here and now. It has been a pleasure hosting you. I look forward to have some heads up, isn't it? It's a hard small, but it must be a lady from Low Nyanza. I don't know, hard small. All right, thanks, bye. Please finish the question. Send to us a well-written answer in the group. Thank you, bye.